Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome everyone, welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to continue to answer more Ask James questions of the day. This first question is from Gerald, and Gerald says, should I sell my NVIDIA investments? Well, that's a great question, right? Let's dive deep into your NVIDIA question from a retirement income perspective. When a stock has run up several 100% in a relatively short period of time, as NVIDIA has, it's often prudent to consider taking some profits off the table. While further gains are possible, remember the old Wall Street wisdom. No one ever went broke taking profits. But let's look at this through a comprehensive retirement lens, right? The first crucial question is about your overall portfolio diversification. If you're retired or approaching retirement, you need to carefully assess how much of your liquid assets should be in the stock market overall. This isn't just about NVIDIA. It's about your entire investment strategy for generating reliable retirement income. Looking at sector allocation, technology requires special attention, right? I generally suggest keeping technology exposure to no more than 20% of your stock holdings, though I hesitate to give specific numbers since everyone's situation is unique. Technology, particularly the AI sector, represents the more volatile end of the market spectrum. So for retirees seeking stable income, this volatility needs to be carefully managed. Let's drill down kind of specifically in the semiconductor industry, right? If you are invested in chips, how concentrated is your exposure? Having all your technology allocation in semiconductor stocks, or worse, in a single company like NVIDIA, creates unnecessary concentration risk. Consider diversifying within the semiconductor sector across multiple companies, or better yet, across different technology subsectors. Think about it in layers. Layer 1, taking profits after substantial gains. Layer 2, overall stock market allocation appropriate for your retirement stage. Layer 3, technology sector weighting within your stock portfolio. Layer 4, semiconductor industry exposure within your technology allocation. And layer 5, individual stock concentration risk. Now, history offers some sobering lessons here. Remember the tech crisis of the early 2000s? The broader market dropped 50%, but technology stocks plunged over 80%. Now, while the general market recovered in about 7 years, the technology sector took 17 years to return to previous highs. That's a long time if you're relying on your portfolio for retirement income. For retirement income planning, consider whether your NVIDIA position aligns with these goals: generating consistent income, preserving capital, managing volatility, maintaining liquidity, providing inflation protection. If you decide to reduce your NVIDIA position, consider reallocating to more income-focused investments, like things we often talk about: dividend-paying blue chip stocks, high-quality bonds, real estate investment trusts, preferred stocks. Maybe there's some funds out there, some low-cost ETFs that generate income, right? Gerald, the key is ensuring your portfolio is structured to provide reliable retirement income, not just potential growth. While NVIDIA's impressive run has likely been great for your portfolio, now might be the time to lock in some gains and redirect that capital towards more income-focused investments. This is an important question about balancing growth and income in retirement planning. It's good you're thinking about it. Thanks for the awesome question. And if you would like to send in your question like Gerald did, you can do so by emailing them to poolelock@poolelocke.com. Our second question today is from Debbie. Debbie says, I'm going to need a lot of income in a few years for retirement. I think we've saved enough, but I really wish that we had saved more. will being more aggressive and in tech help make up for it? All right, Debbie, let's tackle your retirement income strategy question with a focus on long-term security rather than short-term growth potential. The temptation to chase higher returns through tech stocks is understandable, but let's examine why this might be a risky approach for someone nearing retirement. Let's look back at historical lessons. In 1998, we saw the warning signs in the tech sector with significant drops in August and October. Though the market recovered and continued climbing for 15 months, what followed was devastating for tech-heavy portfolios. The broader market fell around 50%, but tech stocks fell by about 80% or more. Even more critically for retirement planning, while the overall market temporarily recovered in about 7.5 years, the tech sector took 17 years to return to previous levels. Here's the crucial consideration for retirement income planning. Most tech stocks don't generate meaningful income. Even if you have enough savings now to potentially generate adequate retirement income through traditional income-producing investments, shifting to a tech-heavy portfolio creates two significant risks. Number one, first risk, what we call the income generation gap. Tech companies typically reinvest profits for growth rather than paying dividends. This means your portfolio might grow in value, but won't provide the steady, reliable income stream crucial for retirement. Number two, timing risk, right? If the market turns before you can transition to income generating investments, you might face a double challenge: reduced capital and insufficient income, right? So instead of increasing tech exposure, consider building a retirement income strategy focused on dividend-paying stocks. They have dividend stocks that have consistent payment histories. High-quality bonds for steady income. Real estate investment trusts for potential income growth and inflation protection. Maybe a balanced fund designed for retirees' income needs. Preferred stocks offering higher yields than common stocks. The reality is that trying to make up for perceived savings shortfalls through aggressive growth strategies often backfires. A better approach might be to maximize current savings in your remaining working years, right? Save as much as you can. Consider working a bit longer, if feasible. Reduce, maybe some planned retirement expenses. Explore part-time work in retirement, right? Structure your portfolio for reliable income rather than speculative growth. Remember, your retirement portfolio needs to serve as your paycheck for potentially decades. The focus should be on preservation and sustainable income generation, not catching the next big growth wave. While tech stocks can play a role in a diversified portfolio, they shouldn't be viewed as a solution for closing a retirement savings gap. Debbie, this is an important question, and it's crucial to align your investment strategy with your retirement income needs rather than chasing potentially higher but riskier returns. Consider working with an income specialist, right? To kind of develop a comprehensive strategy that matches your specific retirement timeline and needs. Hey, thanks for the great question. If you would like to send in your question, you can do so by emailing it to poollocke@poollocke.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.